The path to ruin in the speculative markets is not a sudden, unforeseen catastrophe. It is a slow and methodical process of self-destruction, built upon a foundation of a few simple and eternally repeated mistakes. The average trader believes his failure is a matter of bad luck, of a market that has conspired against him. He does not see that he is not a victim of circumstance, but of his own flawed, undisciplined human nature. Jesse Livermore, a man who walked this path to ruin and back again more times than any other, knew this truth with a chilling certainty. He understood that failure was not an accident, but a choice. A series of incorrect choices, born of the same fundamental errors. His life and his legendary career serve as the ultimate case study in these very mistakes. He was not a man who was immune to error. He was a man who paid a price so high for his blunders that the lessons were burned into his very soul. He learned that to succeed, a speculator must first understand, with brutal honesty, all the ways in which he is likely to fail. He must study his own weaknesses, his own emotional triggers, his own capacity for self-deception. This is not a journey for the faint of heart. It is a deep, unflinching look into the 5 great, expensive mistakes that are the source of all speculative failure. This is not a theoretical exercise. Each of these mistakes cost Jesse Livermore millions of dollars. They are the very errors that are, at this very moment, silently eroding the capital of 99% of all who attempt to play the great game. To understand them is to vaccinate oneself against the most common and lethal diseases of Wall Street. To ignore them is to guarantee that you will, in time, become another one of their countless victims. We will now dissect these mistakes one by one, using the words and the life of the master himself as our guide. The first and most pervasive of all speculative mistakes is impatience, the restless, anxious desire to be in the market at all times. The amateur believes that to be out of the market is to be missing an opportunity. He feels a constant, nagging pressure to be doing something, to have a position, to be in the action. He does not understand that speculation is not a business of constant activity, but of calculated strategic inaction. Livermore learned at a great and terrible cost that the vast majority of the time the correct position is no position at all. He stated it as a fundamental law. There are times when one should speculate, and just as surely there are times when one should not speculate. The market does not owe a speculator a profit every single day or even every single week. The great fortune-making trends, the high-probability opportunities that are the sole legitimate target of the professional, are rare and episodic. They may only appear a few times a year. The time in between is not for trading. It is for waiting, for studying, for preparing, for allowing the market to set up its next great move. The trader who is consumed by impatience violates this principle. He forces trades where no opportunity exists. He plays for small, meaningless fluctuations, chipping away his capital with 1,000 small cuts of commissions and insignificant losses. He is, in effect, trading out of season. His greatest error is not just the money he loses on these ill-advised trades, but the opportunity he forfeits. When the real, powerful move finally does begin, he is often on the wrong side, his judgment clouded by his recent losses, or his capital is so depleted that he cannot take a meaningful position. Livermore's own history was scarred by this very mistake. He told the story of a time he was profoundly bullish on cotton, his analysis telling him a great advance was inevitable. But the market was not yet ready. It was dull and lifeless. Consumed by his impatience, he could not wait. He jumped in with a large line, and the market did nothing. He was forced to sell at a loss. He repeated this 5 times, his impatience costing him a small fortune. Finally, in disgust, he abandoned the trade. 2 days later, the real move began, a massive, explosive advance that he missed entirely because his patience had finally run out. It was $1 million lesson in the catastrophic cost of trading when the time is not right. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. The second great and expensive mistake is averaging down a losing position. This Livermore considered the single most dangerous and unforgivable of all speculative sins. It is a practice born of a toxic combination of hope and ego. A trader buys a stock and it goes against him. The market is telling him with perfect clarity that his judgment was wrong, but his ego cannot accept this verdict. And so he is seduced by the voice of hope which whispers a comforting lie. The stock is cheaper now. It is a better bargain. Buy more and you will lower your average cost. To the amateur, this feels like a shrewd, strategic maneuver. He feels he is taking control of a bad situation. In reality, he is committing financial suicide. Livermore was absolute on this point. Of all speculative blunders, there are few greater than trying to average a losing game. It is to reinforce failure. It is to throw good money after bad. It is to argue with the infallible verdict of the ticker tape. It is a battle that can have only one outcome, the total annihilation of one's capital. He understood the flawed psychology perfectly. The trader is no longer operating on a reasoned analysis of the market, but on a desperate, emotional need to see his original opinion vindicated. He is doubling down not on a sound premise, but on a proven mistake. The loss, which was once small and manageable, now begins to grow at an exponential rate. His risk has not been reduced, it has been multiplied. He is now more vulnerable than ever to the very trend that has already proven him wrong. Livermore's own rule was the polar opposite. He never, under any circumstances, added to a losing position. His first loss was always his last, and his best loss. He did, however, with great confidence and aggression, add to his winning positions. He would pyramid his successes, buying more as the price advanced, always on a rising scale. He was reinforcing success, not failure. The trader who averages down is a general sending his best troops into a battle that is already lost. The professional speculator, in contrast, sends his reserves only to the front where the battle is already being won. The third expensive mistake is trusting outside opinions and tips over the verdict of the tape. The amateur speculator is a man who craves certainty in an uncertain world. He does not trust his own judgment, and so he seeks it from others. He listens to the whispers of friends, the confident pronouncements of brokers, and the supposedly secret knowledge of insiders. He is a perpetual tip-taker, a man who has abdicated the difficult and necessary work of his own thinking. Livermore knew this to be a path of certain ruin. He learned through painful and costly experience that even the most well-intentioned advice from the most knowledgeable of sources could be fatal. He recounted the famous story of his trade in Union Pacific at Saratoga. He was long and the stock was acting beautifully, confirming his own reading of the tape. But a close and well-respected friend, a broker with access to the highest circles, advised him with the utmost sincerity to sell. He insisted that the great insiders were unloading the stock. Livermore, in a rare moment of weakness, allowed this friendly, persuasive voice to overrule the clear, objective voice of the tape. He sold his position and even went short. The very next day, the company announced an unprecedented dividend, and the stock exploded upward in one of the most violent advances of the era. It was a costly lesson in the danger of trusting any opinion over the market's own registered facts. An even more devastating experience came from his association with the brilliant Percy Thomas. He allowed the man's magnetic personality and persuasive arguments to convince him to take a massive long position in cotton, directly against his own better judgment and the tape's clear warnings. He was no longer trading his own game. he was trading another man's convictions. The result was his single greatest financial loss, a mistake that cost him millions and nearly drove him from the game for good. From these experiences, he forged an unbreakable rule. Beware of inside information, all inside information. He understood that an insider might tell you when to buy, but he would never, ever tell you when to sell. To do so would be a betrayal of his own interests. The speculator who buys on a tip is a man who has been given a key to a house, but has not been told where the exits are. He is trapped. Livermore's conclusion was absolute. The ticker tape is the only true and reliable insider. Its information is available to all who have the patience and the skill to read its language. It is the only voice a speculator should ever truly trust. Having examined the first three great and expensive mistakes, the sins of impatience, of averaging down, and of misplaced trust, we now arrive at the errors that are born not of inexperience, but of success itself. These are the mistakes that often follow a period of great winning, the traps that are laid by a speculator's own burgeoning confidence and his swelling ego. They are, for this very reason, the most insidious and the most dangerous of all. Jesse Livermore, more than any other, knew the perilous landscape of the victorious mind, and his life offers the most profound warnings against the arrogance that so often precedes a great fall. This brings us to the fourth expensive mistake: betting too big. After a string of successful trades, a speculator begins to feel infallible. The market seems an easy and accommodating thing, a personal ATM from which he can withdraw funds at will. He forgets the cold, hard lessons of his past losses and begins to take liberties with his capital. His sense of caution erodes, replaced by a feeling of invincibility. It is at this very moment of maximum confidence that he is at his most vulnerable. Livermore described this phenomenon with the clarity of a man who had been its victim. He said, "The speculator in such instances loses his sense of balance. The money, having rolled in so rapidly, feels unhealthy. It ceases to be real capital, the lifeblood of a serious business, and instead becomes mere ammunition for a thrilling game. The speculator, intoxicated by his own success, begins to risk a sum on a single trade that is so large it violates all the principles of sound money management. He is no longer a professional speculator. He has become a reckless plunger. The desire to make the market pay for one's luxuries is a particularly dangerous manifestation of this error. Livermore saw it constantly. A trader, flush with victory, would decide that the market should buy him a new automobile or a fine piece of jewelry. This, Livermore knew, was a hoodoo, a certain path to ruin. To trade with a specific, desired sum in mind is to abandon all pretense of objective analysis. The trade is no longer a calculated speculation, but an emotional demand placed upon the market, a demand that the market is under no obligation to fulfill. The professional speculator, in contrast, treats his capital with the utmost seriousness. He understood that cash to the speculator is as merchandise on the shelves of the merchant. It is his inventory, the essential tool of his trade. To risk a huge portion of it on one venture, no matter how certain it seems, is an act of terrible business judgment. A wise merchant would never risk his entire inventory on a single customer. A wise speculator must be equally prudent. He must, Livermore insisted, risk only a limited amount of capital on any one venture. Livermore's personal solution to this was a model of discipline. He recounted how, after a particularly successful campaign, he would make it a habit to draw out a large portion of his profits in cash. He would take hundreds of thousands of dollars out of his brokerage account and lock it away in a safe deposit box. He did this because he knew that the only money that is ever taken out of Wall Street by speculators is the money they draw out of their accounts after closing a successful deal. It was a physical act of making his profits real, of protecting them not just from the market, but from himself. This brings us to the fifth and final great mistake, an error that is the very essence of the amateur mindset and the root of so many others, fighting the tape. This is the ultimate act of speculative ego. It is the refusal to accept the market's verdict, the stubborn insistence that your own opinion is more valid than the market's own registered factual action. It is the speculator who, holding a losing position, declares, "The market is wrong and I am right." Livermore knew this to be a form of madness. He operated on a single, unshakable belief that served as his compass in all conditions. Markets are never wrong. Opinions often are. The ticker tape was, for him, the ultimate and only truth. It was the final judge and jury, and its verdict was absolute. To argue with it, to fight it, to hold a position in defiance of its clear message, was not an act of courage. It was an act of pure, unadulterated vanity. The trader who is fighting the tape is a man who cannot admit he has made a mistake. His pride is on the line. He has told his friends, his broker, and himself that a stock is going up, and now that it is going down, he cannot bring himself to accept the humiliating truth. He holds on, his losses mounting, a prisoner of his own initial flawed opinion. He will tell himself, "On the next rally I'll get out." But when the small, feeble rally comes, his hope is rekindled and he once again fails to act, only to see the stock plunge to new, more painful lows. Livermore learned to eliminate this self-destructive impulse entirely. He was never wedded to one side of the market. His only allegiance was to being on the right side. The moment the tape told him he was wrong, he did not hesitate, he did not argue, he did not hope. He acted. He closed his position, accepted the small loss, and cleared his mind. He knew that the market is not a personal adversary to be conquered, but an impersonal force to be understood and respected. He likened the trader who fights the tape to a man standing on a railroad track. He told a friend, "If I were walking along a railroad track and saw an express train coming at me 60 miles an hour, I would not be damned fool. Enough not to get off the track and let the train go by. After it had passed, I could always get back on the track again if I desired." This simple, powerful analogy was the core of his philosophy. To stay in a losing position is to stand in front of an express train. The only sane, logical, and professional course of action is to get out of the way. These 5 great and expensive mistakes, then, are the primary causes of all speculative failure. They are the sins of impatience, of hope-fueled recklessness, of misplaced trust, of arrogant overconfidence, and of stubborn, ego-driven defiance. They are not external market forces, but internal psychological flaws. They are the enemy within, the timeless human weaknesses that the successful speculator must, through a lifetime of discipline and self-analysis, learn to conquer. To avoid them is to embrace the path of the professional. It is to trade only when the great opportunities are present. It is to cut every loss without hesitation. It is to trust only the market's own confirmed action. It is to guard your capital as the sacred source of your livelihood. And it is to accept with profound humility that the market is always and eternally the master. This was the great lesson of Jesse Livermore's life, a lesson paid for in millions, a lesson that remains the only true path to survival and to ultimate victory in the great game. To truly understand the mind of the man who learned these lessons, to witness the epic market battles where these principles were forged in the crucible of real-world profit and loss, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below.